we bring in our panel to discuss the Federal Open Market Committee minutes from the last meeting. Of course, we've seen the Fed doing several rate cuts over the last year or so. Rates are still relatively high. The 10-year bond sitting around 4.5 right now. But it seems with these minutes that the Fed is comfortable to stand pat right now, pause, and not make any quick moves. Brian Jacobsen's with us, chief economist at Annex Wealth Management, and Gregory Daco, chief economist at EY Parthenon. Thank you both for being with us. So, Brian, I saw that you were looking at the minutes. You think that equities seem fairly comfortable with the Fed on hold. In fact, they said they're well positioned to take the time to assess the evolving outlook at this time. Some of your thoughts.
Yeah, I think reading through the minutes, it really suggests that the default position of the Fed has moved from inclined to cut to just staying on hold. It hasn't shifted towards the risk of them actually hiking. So it would actually take, I think, a really significant deterioration in the growth outlook coupled with stronger inflation for them to consider hiking rates because they really want to build their credibility with inflation. That's not really in the cards. So I think that really what they would be inclined to do is just prolong this pause that they're on. Let's see how things shake out when it comes to tariffs, immigration. Do those actually show up in the data in terms of a supply shock? Does it affect prices? And then they might react. So I think they still are very data dependent. They want to see the whites of the eyes of inflation before reacting to it. And so the equity market can kind of just take this in stride, I think.
All right. Well, I peeked up here at the Dow, which is now positive, folks. It is now up 2 points. At the start of the show, the Dow was down 138 points. The S&P and the Dow have both moved higher after we received the Fed minutes. Gregory, tell me more. Where do you think we could be headed here?
Well, I think it was well said that we have the Fed that's really on pause right now. The FOMC minutes essentially confirmed the hawkish conditionality that Powell expressed during the post-FOMC meeting press conference, in essentially highlighting that we need to have a further lowering of inflation in order to further ease monetary policy. And I think that really puts the Fed on a trajectory of perhaps 2 rate cuts this year in June and December, which is our current baseline. But even that is a risk because if the administration's policy mix, including tariffs and immigration restrictions, prove to be inflationary, then the Fed would be forced essentially to maintain rates at a higher level for longer and potentially, as was just suggested, consider rate hikes if inflation does indeed reaccelerate. The data dependency, in my opinion, has served them well in the past, but going forward, it will be very delicate because that will make the Fed extremely reactive to any bumps in the road on the inflation front and on the policy front.
And the Fed, to your point, seems very ready to react one way or the other as needed. In the meantime, there are some concerns that equities, or at least some parts of the equity market, could be overvalued or take some profits, et cetera. I'd like for Brian, you mentioned, for example, that equities seem comfortable at this moment with the Fed on hold, but you're looking to other areas. You said international, SMID caps. Tell me a little bit about what you think could work.
Yeah, I think looking forward, when I look at valuations, market multiples aren't really a good predictor of where markets are going to go in the near term. You always have to look out, valuations do eventually matter, but over like a 5 to 7 year horizon, if you're thinking 5 to 7 months, where are the opportunities now? It's really driven mostly by sentiment and some of the surprises. And so I always try to think about, well, where is the next likely surprise? And maybe the surprise is going to be in terms of with tariffs that they don't actually get implemented, or at least to the magnitude that they are. And if they do, it's not going to be as crippling to profits as what investors might have in the back of their minds that it could be, right? We know that businesses still do have a decent amount of pricing power. Consumers are pushing back on price increases. But when I look at profit margins, where are those areas, those companies that most likely have that moat around their margins to protect those if we do get tariffs or any other sort of like geopolitical shock? It seems to me that more and more of that is in the small and mid cap space. I mean, clearly, margins in the large cap growth space are really, really elevated. But that's where I think that those margins could be vulnerable to a little bit of compression. And if those margins come down, I think the multiple will come down with them as well.
All right. And Gregory, as the economist here on this panel, it takes the consumers to feel confident to spend, to keep boosting GDP, to keep everything going. We think about consumer stocks, consumer discretionary. How do you think consumers will behave in 2025?
Well, we still have a lot of fuel in the tank in terms of the momentum. We still have solid income growth. We still have an environment where overall the financial health of households across the U.S. is still generally healthy. But I think one point is important to keep in mind. We have a bifurcated consumer outlook. Some families at the lower to median end of the income spectrum are more sensitive to price increases, higher interest rates, and they're the ones that are being more judicious with their spending and with their outlays. Families at the upper end of the income spectrum still have a little bit more capacity to withstand these higher prices and higher interest rates. But let's not forget, we have an economy that is relatively healthy today, but some of the policies that are being put in place could hinder growth via higher inflation and lower economic activity. And some of the margin compression that was just discussed could be a hindrance in terms of further capex down the road and further employment growth. Those are downside risks that we have to be conscious of. And I think that was reflected in part in the FOMC minutes, with policymakers noting some potential downside risks from the administration's policy mix.
Gregory, Brian, great to see you both. Thank you so very much. Brian Jacobsen, Gregory Daco, thank you.